Hey guys, Damon Varial here. It's been a long time since I've done a top 5 video, so I thought I'm going to do a top 5 dividend strategies video in light of 2020 bringing down a lot of prices for stocks, but especially in certain sectors. So I got the top 5 dividend stocks for 2021. You're looking at them now, and I'm going to go through each one of them really briefly because if you're going to buy a dividend stock, you're generally going to hold for a long time. So I'm assuming that you're going to do your own research outside of what I'm going to show you today before you buy those stocks. But I'd like you to learn at least one thing from each of these. So these are my top 5 picks, and I got reasons for each. I looked into them, spending a lot of time on each one. But for each one, I just want to give you like one idea here why this in particular is a decent dividend stock. So we're going to start with Pfizer. And Pfizer, as you know, is developing a vaccine on the coronavirus, but that's not exactly why we want to buy this stock as a dividend stock. In many cases where it's a news-driven rise in price in the stock, you don't buy it for dividend safety. You buy it because you think the stock's going to go through the roof on some sort of invention, whether it be a vaccine or cure for cancer. But one thing that's good about Pfizer is it's a very consistent biotech company. It's always putting out new products and it's always gaining a lot of revenue from those products. What you can do for a biotech stock is go look at its pipeline. The pipeline for a biotech stock is essentially what the company plans to put out in terms of drugs and its future development. So this is actually a very difficult field of stock to look into because you've got to know what a phase 1 trial is, what the difference of a phase 1 and phase 2, phase 3 trial are, and you need to know how those results affect the stock price of a company who's dealing in biotech. And I have a different video on this subject, how to predict pharmacology studies from biotech studies. You can check through my channel to find out what exactly I'm looking for when I'm playing that kind of strategy. But this isn't that kind of strategy. This is more of we know this company is strong, it's consistently putting out new products, and because of that, it's going to always have new revenue sources. And as its revenue sources grow, the company's going to be able to increase its dividend and continue paying its investors via that dividend. That's Pfizer. So that's kind of like a general idea. And you might think, okay, I need a biotech stock. Well, look through the biotech stocks. One thing I want to show you here is this free site I use, Finviz.com. What you can do here is just leave the tickers blank, and you go into sector, and is there a biotech sector? No, go into industry, and you can scroll down to biotechnology, and it'll give you a list of like all the stocks. I always choose over $5 and optionable. Over $5 because under $5 a stock is technically a penny stock, and those are really risky and not so trustworthy. There's a lot of pump and dump schemes that go on through newsletters, so I try to avoid those types of stocks. There are penny stock trading strategies that do work pretty well, but that's in a different that's not the topic of our video today. Also, I choose optionable simply because I like playing options, but you can set whatever you want here. Just leave this blank in tickers, hit enter, select your industry for biotech, and we got 245 biotech stocks, and you can arrange them however you want. I think I don't know if you can make it to where you can see more than 20 results per page. You might be able to do that if you get the paid version. But in any case, if you're interested in different biotech companies with dividends, what you can do is go over to dividend, right here, dividend yield, and select positive, and that'll screen out the stocks with positive dividend yields, and for some reason Pfizer is not in there. So hold on a minute here. You know what? Here's what I'm gonna do. I'm gonna figure out where it's at. Any PFE is the ticker. drug manufacturers. So that's what you want to look for, drug manufacturers. And you get a list of all of them. And then if you're interested in dividends, then you select dividend yield is positive, and we only got 14 stocks here. But you get the point. So if you want to do your own research, go for it. Pfizer has a 4% dividend, which is pretty much standard. It's considered a decent dividend. I'm going to show you some much higher dividend yields with these next 3 or 4 stocks. And you got to realize that the reason the dividend is high in certain stocks, it's a situational thing, but in many cases, people consider high dividends to come with high risk. So the next one we're going to look at is ExxonMobil, and people consider this a rather high risk stock because it's in the oil industry, and the oil industry, as you know, is down in the tanks. Now, if you want to do a sort of like macro prediction on this, just like we did with Pfizer, we're thinking, well, they constantly have new revenue from their products. They're going to put out a vaccine. That's going to bring them revenue. You can think the same thing with Exxon. After coronavirus is gone, people are going to go back to moving around in their cars, moving around in airplanes. Oil prices are probably going to go up, and that's going to help Exxon. But another simple way of looking at it is the idea of mean reversion, which means that industries that tend to be going down for quite a while will eventually reach a sort of support where they can't go much lower. And mean reversion says that it will revert toward the mean. It's a statistical concept, but in the stock market sense, it's simply saying that if the market's going up and a certain sector is underperforming, that sector will eventually begin to outperform. So here we got an oil company that's well known and it's really too big to fail. So we're not going to feel much risk here, especially if you look at dividend history. If you look at the dividend history of a certain stock, it gives you an idea of whether that company has been able to consistently pay and increase its dividends. And what I like to do is go to Seeking Alpha. I'm not sure if you can see this. I'm logged in, but I'm pretty sure you can get a free account, and even without an account, you could probably see this page. Just go to Seeking Alpha. You select the symbol, and then once this pops up, you're going to scroll over to dividends, click on dividend history. This is going to give you a history of all the dividend payments. And if you see like some areas missing or the chart going down, that means the company cut its dividend. And history can tell us whether the company is consistent in paying. And one thing I really like to look at is, first of all, recently, has the company cut its dividend during Corona times? And for Exxon, the answer is no. Even though the oil industry is really, really bad at the moment, they've still kept that dividend up. And secondly, I like to go back to 2008. You can just grab this and pull it to the left. See if they cut their dividend in 2008 during the financial crisis. And if they didn't and they managed to continue paying, you can be pretty sure that this company is not going to ever cut its dividends. So you're not going to get in when the dividend's at 9%, and then you have a very low probability of seeing that yield go to like 4.5 or even down to 0. It's not as risky as many people think. People see a 9% or 10% dividend yield and they think, oh, that company's got to cut its dividends soon because it's way too high. But that's not always the case, especially in a company that is, too big to fail, like ExxonMobil. Moving on to utilities, which is a very safe field. I found First Energy to be a pretty reliable company here. It has a 6% yield, and this yield is pretty rare in the company's history. I want to teach you guys about this idea of locking in a yield, which is when a stock price falls. See, the dividend is kept constant. The dividend is per share. It's usually kept pretty constant. Well, dividends will rise, right? But let's say the dividend doesn't rise except for maybe once per year, as you'll see here. Usually the dividend increase comes once per year. And if that's so, that means when the stock price is down, you're still getting the same amount of dividend, but you've kind of locked it in at a lower price. So let's just say here, 2019. Oh, by the way, I'm looking at stockcharts.com, which is free. very useful charting system. Um, and if you want to see the whole chart, the default is not like this. The default doesn't give you 5 years. You got to go down, scroll down to 5 years to get the whole chart. But the idea here is this stock price has gone up through 2019. But if you look at the dividends stayed consistent, right? 38 cents per share. So if you bought here, you're getting 38 cents per share at a price of $35 per share. But if you bought at the end of 2019, you paid maybe 25% more than what I paid at the very beginning. But you still get the same dividend, just your yield is much lower. So I might be getting a 6% yield while you're getting only a 3% yield. And the whole point of dividend investing is to sit your money somewhere and just keep collecting a certain amount of percent of that money that you put down. Now you're going to be collecting more percentage-wise if you buy at a low price. So here we're looking at First Energy that's offering a 6% dividend, and you can tell that it's very high dividend amount because the stock price is low. Here it was probably something like 3%, right? Now we've got a 6%. It's very rare in this company's history, but this company is a decent utility company and it's pretty consistent in terms of putting out its dividends. So it's trustworthy, and now you've got a pretty rare opportunity of buying the stock at a low, which also means getting the dividend yield at a really high percentage. And you'll keep that percentage, you'll lock that percentage in even when the stock goes up. The stock goes back up to 50. Well, now you've got capital gains at 50. And you also have the dividend yield is still 6% of your initial down payment. Moving on to a different industry. This is the insurance industry, Prudential Financial. So, I mean, there's not much to say here. The insurance industry usually pays pretty decent dividends. But I want to show you how to look for long-term dividend stocks. That is, you want to put down money now and hold for many, many years, assuming that the company is consistently increasing its dividend amount. So maybe now you're getting 32 cents per share, but 10 years from now, hopefully you're getting $1 per share. So that's a way of investing to where you're getting passive income that's increasing over time. And one way of looking for that is to look at the company's financial trends. So what I use is this Simply Wall Street, simplywall.st, Simply Wall Street. It's not free, but there is a free version. But I use this mainly for my fundamental, just getting a general overview of the stock fundamentally. And it gives you this like nice little snowflake at the beginning. Here we're looking at the dividend. It's a pretty good and reliable dividend stock. But what I really like to look at through here is, first of all, we want to go cash flow. So I want to look at cash flow. I want to look at the cash flow's future growth. This is future growth. Yeah. So, I mean, here, cash flow is kind of going down. Well, right now it's going up, isn't it? No, it's going down. You want to look at cash flow, and you want to look at the forecasts of earnings growth. So here, within the industry, Prudential is really, it's forecasted to be much more outperforming, very outperforming relative to its industry. I'm not sure what words I should put here, but basically the idea is its earnings growth are predicted to outperform the earnings growth of the average stock within this industry. That is, if you're interested in the insurance industry, this is a company that is set to outperform. Now that depends on whether you believe this depends on whether you believe the forecasters. But in general, if you look at these trends and you can see, well, they're set to be like this, well, that means the company is going to be able to, they're going to have extra money, which means they're going to need to do something with that money. And for a very old style industry like insurance, there's not much you can do to renovate or innovate. It's not like tech. You can't invest in new products or anything like that. So a lot of these insurance and financial companies in general, the way they use that extra money, those extra earnings, is giving back to the shareholders, whether that be via dividends or buying back shares so that each share that you're holding is worth more. That's the way they generally do it. So this is one you can check out. Look into, you can again go back to Finviz, select the insurance company, insurance industry. You'll find it down here for sure. There we go. I believe this one's diversified, but you also have like life insurance and property insurance. You can check through here. But in general, what I want to say here is this is a company that is probably going to hike its dividend pretty consistently in the future. We're going to see some dividend growth because this company is just outperforming. And the financial industry in general is just like the oil industry right now. It's underperforming. It's going to undergo mean reversion eventually. So you're also going to see some capital gains there. Now, the last one I want to get to is kind of a lead into my next video, and that is XLE, which is not a stock, but it's a basket of stocks. It's an ETF, which is called an exchange traded fund. And you'll see right here, the dividend yield is way bigger than all the other ones. And that's because you've got a basket of stocks. We looked at ExxonMobil and First Energy, which are both in the energy industry, but these are safer stocks. So they offer lower than average dividends within that industry. The energy ETF is a basket of all stocks that are within that industry. And that means you're also getting a lot of, while you're getting diversification, you're also getting a lot of risk from those weaker companies. So you're going to get a higher dividend because with higher risk comes higher reward. And I'll talk more about ETFs in the next video. I want to give you 5 top dividend ETFs for 2021 in the next video. And you'll see a lot of them have really, really high yields. So I think that pretty much concludes this video. Again, you got a pretty much a safe bet for 2021, especially with coronavirus. You also got, a safe bet within a risky industry that's probably also going to recover after the coronavirus vaccine is put out there. First Energy is even safer because it's an electricity distributor. It's not in the oil industry. Then you got a pretty standard financial stock. And we'll look at maybe a financial ETF in the next video as well. So check that out. And if you have any questions or you have a request for a certain video, just leave that request or your question in the comments section below. Thanks for watching.